Welcome to our IFRS and Corporate Reporting webinar for December 2025. This is actually our last IFRS and Corporate Reporting webinar for this year. My name is Dean Arden. I'm one of the IFRS and Corporate Reporting partners in the Melbourne office of BDO. I'll be your tour guide today for the topic, which is the tricks and traps of fair value measurements. Now, I have to make an apology. Aletta is an apology for today. She was intending to attend, and Kevin is also an apology today. No, the rumour is that they've both been attending the Christmas party. That's not true. They've both been working very hard and unfortunately had commitments that they couldn't move around. So you have the benefit of my dulcet tones today to talk about the tricks and traps of fair value measurement. Before we start, just like to acknowledge the traditional custodians of the country throughout Australia and their connections to land, sea and community, and pay our and my respects to their elders past and present, and extend that respect to all Aboriginal and Torres Strait Islands peoples on the webinar today. As I mentioned before, this is actually our last IFRS and Corporate Reporting webinar for the year, so it's been a full year of topics, listing them there. Today's topic, obviously, tricks and traps of fair value measurement. It's also next week will be the last IFRS sustainability webinar that we'll be running as well. So on the 17th of December, ensuring your mandatory sustainability report is assurance ready. Now, certainly an important topic in the sustainability world at the moment. I'd like to highlight to you that we've got the webinars for sustainability booked in for next year, 2026. Sounds a bit weird, but yes, it's nearly the new year, 2026. 12 webinars that we've got registered and we're ready to be accepting of attendees. So if you're interested, and certainly encouraging that this is the first year, we are talking right now about the first year sustainability reporting, what's in store next year. If that's an area that's of interest to you, would really suggest that you don't recommend that you enroll for those. Likewise, registering for the 2026 monthly IFRS and Corporate Reporting webinars as well. Next year, unsurprisingly, we are dedicating it, other than the standard June and December updates, the entire year is actually going to be dedicated to IFRS 18. It's actually a topic, and we've talked about it briefly, we've talked about it in various other webinars and presentations, but we decided that it's actually a standard that is actually quite significant. The more you get into it, the more you realise that it actually is going to be quite a substantial change for a lot of entities. For those, not only for those that have, a specified main business activities, but also those that don't. So as a consequence of that, we've decided that we're going to actually dedicate the entire year pretty much to IFRS 18 to make sure that entities, including our clients and everyone, are fully understanding of what IFRS 18 requires and are prepared on transition. In addition to the webinars, we will be running some masterclasses as well next year. The dates and topics for those will be going out, but we'll be looking to run a couple of masterclasses looking at some practical aspects of the application of IFRS 18 and also looking at the management performance, management-defined performance measures, as well as a way of as hopefully building some understanding and certainly some competence in the industry around IFRS 18. I'll mention again the AASB S2 checklist. It's still out there, a really helpful guide, obviously at the moment for those entities now that are 31st of December reporting, to ensure that their financial statements, or what their draft financials, that is their draft sustainability report, meets the requirements of IFRS S1 and S2, particularly S2 on the disclosure front. Just reminding you obviously of the 4 pillars of disclosures that are required under IFRS S2, the general requirements under IFRS S1, and listed at the bottom of the slide there, you can see that the number of disclosures are quite significant as you start to, as they accumulate through the actual report. So again, something that could be useful to you, certainly ensuring that your draft sustainability reports are compliant and are complete right now would be a really useful outcome. Just mentioning some of the other aspects of the checklist, certainly it gives you an assessment about your gap, the level at which you're actually meeting the requirements is a useful aspect as well, to be able to then focus your resources going forward to understand where you should need to allocate more effort to actually ensure that your disclosures are fully and compliant. More evidence of more advanced examples of the spread of the checklist, ensuring that you are fully compliant. We'll move on to today's agenda. What I want to do today is talk about IFRS 13, not from a valuer's, necessarily a valuer's perspective, but talk to it from an accountant or an auditor's or a corporate finance team's perspective. So what are we looking for when we're dealing with it from our perspective as an accountant, an auditor, or from a corporate finance perspective? This, and hopefully nobody's misunderstood the purpose of this webinar. This webinar will not make you a credentialed or qualified valuer. The purpose of this webinar is really to give, from an accountant's perspective, an auditor's perspective, and corporate finance team perspective, an understanding of what they should be looking for when they receive fair value measurements, or when they are involved in having them prepared by valuers or having them prepared internally based on internal models. So as a quick refresher, we'll walk through some of the key features of IFRS 13, making sure that everyone sort of understands the key features, the definition, the expectations around what a fair value measurement looks like. Then I've just divided it up into the rest of the presentation between 5 tricks of fair value measurement and 5 traps of fair value measurement. The tricks and traps have basically been informed by 5+ years of experiencing fair value measurement in financial reporting contexts. So let's push through to the refresher. I wouldn't expect that you're going to read through this entire slide, but I wanted to give some perspective of exactly how pervasive fair value measurement is throughout IFRS and therefore Australian accounting standards. I've just split the screen there between two columns, one being the column listing those accounting standards that require fair value measurement. So looking through those, IFRS 2, noting IFRS 2 is slightly different than the fair value measurement in IFRS 13, but acknowledging that it is a fair value measurement. Working through IFRS 3, IFRS 5, IFRS 7, obviously that's disclosures, IFRS 9, 10, 15, 19, IAS 19, IAS 41, then our local accounting standards, AASB 1058 and 1059, both require fair value measurement. Again, 1059, again, slightly specified, a slightly nuanced fair value measurement, but a fair value measurement nevertheless. So when you think about that, fair value is a really pervasive measurement model that actually, unsurprisingly, the standard setters like, because it does take a lot of management judgment and expectation out of the process. And I'll talk to that point later, but it's important to understand that fair value is one of the key features and probably one of the key strengths of fair value measurement, is the fact that it takes management discretion out of some aspects of that, or most aspects of that valuation. Now, just casting your eye to the right-hand side of the screen there, and the prospect that there may be circumstances in which you could actually apply fair value, but you're not required to. IFRS 1, obviously, for transitioning to IFRS standards, allows you to transition using some fair values in some circumstances. IFRS 9 has some fair value options in it. IFRS 16 has some fair value relating to investment property that are leases. IFRS 17, insurance contract, only really applicable on inception, but therefore it's still a part of the standard. So you could still have insurance portfolios appearing for the first time at fair value. So the options under IAS 16, IAS 20, 27, there's options in there around valuing parents' investments in subsidiaries and other entities. IAS 36, there is the prospect that you can do fair value when you're doing your impairment modelling. IAS 38, intangible assets, we don't see that as much, but there's still the option that's still available. Obviously, it's restricted to scenarios where the asset is traded in an active market. And IAS 40, which is pretty common for the investment property industry. So quick refresher, definition of fair value. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So there's a couple of key features there. I'll highlight them, but I'll go in a little bit more detail, into the next couple of slides. But the key parts, probably that definition to remind yourself of, are that it's an asset, that it's the price that would be received to sell an asset or paid to transfer a liability. So it's about a transaction. It's not about a cost. It's not about some other number. It's about a transaction. And it's about a transaction which you are actually disposing of the actual item that you're accounting for. It's an orderly transaction between market participants. So it's not a forced sale. It's not a distressed or duressed sale. It's a sale that's accompanied by a normal period of, or expected a normal period of normal period of marketing and ensuring that you can actually find the right buyer for it and the highest price. And it also involves market participants. So there's this sort of anomalous concept in IFRS 13 that talks about market participants. They're hypotheticals, they're not real people. You don't have to go out and actually identify actual market people, but you have to imagine that they are people that would be in the market and looking to buy or acquire the asset or liability that you're trying to sell. And it's specified as at the measurement date. So there is a timing aspect to it as well. So it's not a fair value at any point in time. It's a fair value at the measurement date. Now the measurement date, subject to the accounting standard you're dealing with, could be a reporting date, it could be a transaction date. So you break it down a little bit there. So exit price focus reflects that amount an asset would be sold for. Now typically we talk about bid price in that context, or a liability transfer, and again transferred, and we talk about an ask price in that situation. Typically the fair value will be somewhere within that bid-ask spread. Now, where it is in that, the standard is not definitive about it. It just simply says it's the point within the bid-ask spread that's most representative of the fair value. So it's representative of the price that would cause that transaction to occur. It's an orderly transaction, I mentioned before. It assumes a normal sale process, not forced or distressed sale or transfer. It's a hypothetical market participant. Now that's really interesting, because what that does is it means if you are not required to think about someone specifically as the market participant, what it sort of means is that it sort of breaks all the shackles about what your assumptions might be about them. So how much do they know? What's their business? How might they use the asset? You're not constrained by those factors. So you probably have to then think, well, if this is a hypothetical market participant, hypothetically they should know the asset, they should understand what the risks are with it, they should understand that they have, maybe it's a type of asset they have to use in a particular context, and so you might expect that market participant therefore would have that context to deal with. So they might have the associated assets that make that asset valuable to them. The transaction will occur in the principal market. Now, the principal market is usually the most active, and it's the market that the entity that's trying to value the asset or liability would normally transact in. Now, in some cases, you might have situations where you don't normally transact on that particular asset or particular liability, in which case, and that's particularly the case with liabilities, often you don't see entities selling liabilities or transferring them because entities often won't assume that liability. There are some markets out there for liabilities. If you look around the world, you can see things like, for example, insurance portfolios, and they're typically liabilities. But you'd see that there are markets out there. It's just often that they're not ones that necessarily entities always trade in. So in the absence of a principal market, then you have to find the most advantageous one. And we'll talk about that in a bit more in detail in a minute. And it's measured at the measurement date, which could, as I mentioned before, could be the reporting date, could be a transaction date, depending on what the accounting standard says. So they're the parameters that we're working in. Just to break it down a little bit more, the unit of account. Unit of account is a really interesting concept in accounting. There isn't a real strict definition of it, but it's actually quite a pervasive concept that runs right through accounting standards. So consequently, it's really important to think about a unit of account. I can't give you a really good definition, but maybe with the way conceptually to think about it is, and it's often specified in the relevant accounting standard, the unit of account is it's defined as either the legal boundaries of the asset or liability, or it could be seen as the contractual boundaries of the asset or the liability, or it could have a physical boundary as well. So if you think about, just off the top of the head, think about a loan agreement, say your mortgage. The mortgage is defined by the mortgage document that you've signed, and maybe any other legal arrangements that might be connected to it, such as fair trading and various other things that legally support the issue of the contract. So the boundary, the unit of account, is the contract. And so everything within the contract we'd account for, and we'd include if it's relevant to our fair value measurement, but everything outside of it we'd exclude. Okay, so now think about an item of property, say a building. So the land and building, so the land would be based on a legal deed, the actual land, the land ownership, and the building that sits on top of it would also be part of that. But within the building, there might be other things. So it could be an empty shell, or it could be something more substantive. And so the unit of account then is defined by physically, not only legally, but physically what it is. So unit account's usually specified within the accounting standard, and it's usually related to the definition of the thing that you're dealing with. But when you're doing a fair value measurement, you actually have to then take into account the characteristics of that asset or liability. Once you've identified the unit of account, it's all the characteristics within that asset and liability, within the boundary of that asset or liability, which are relevant to the actual fair value measurement. So you need to think of things like condition and location of the asset. So that would be something physical asset you'd think about. Any restriction on the sale or the use of the asset might impact the price ultimately paid. Now, it's important to also remember that, and I'll talk a bit more about that in a couple of slides, but restrictions over the transfer, you need to be careful about whether they're entity specific or asset specific. Now, if they're entity specific, they're not a part of the fair value measurement because they're outside the boundary, the unit of account being the asset. The restriction on sale is something that's imposed on it. It's not a part of that thing. But if there's something that is restricting an asset and it's actually connected to the asset, then that might be relevant to the actual valuation. So the kind of things I might be thinking of is where you have maybe covenants over land, or you have some legal restrictions over land. So it's not necessarily to do with you as the buyer, it's got to do with the actual land. We'll come back to those in a minute. Highest and best use is really important in non-current and non-financial assets. When we think about the fair value of a non-financial asset, it's got to reflect those market participants' ability to use the asset in its highest and best use. And I suppose when you think about it, make a contrast to financial assets. So for a loan, the highest and best use of a loan is presumably to hold on to it until the cash is all paid, unless there's some risk about it being default, in which case then it might be about the security, which again is legally constrained within the terms of the agreement. When it comes to non-financial assets, like you think about property, plant and equipment, they can be used in different contexts and they can be used for different purposes. And so it's important in that sense, and I've got some examples later to go through, but it's important to understand that they can have different uses, and therefore from a fair value measurement perspective, we have to think about what's the best possible use. Now when we think about possibilities, it has to be physically possible, so you have to, you can't make something out of nothing. Or, it's important to understand that some assets can't be converted into everything or anything. So it has to be physically possible. It also has to be legally permissible. So often when we're talking about land, we're thinking about rezoning, and it has to be financially feasible. That is, it's restating this property into something else might not be financially viable for various reasons. For example, the land might be contaminated, in which case you might say, well, look, it'd be nice to be able to rezone it, but it's not going to happen because financially it's not going to be sustainable. It's assumed to be the correct use. So whatever an entity is you're currently using non-financial asset for, it's usually assumed to be the best use unless there's evidence to suggest otherwise. We normally assume that everyone's a rational actor, and so therefore what they're using the asset for is the best use. I mean, having said that, I've seen plenty of scenarios. I used to live in a inner city suburb where next door to me was a fitter and turner's factory. Unsurprisingly, by the time I lived there, the fitter and turner's factory became converted into units because the value of the land was much more, it was greater in that context as a residential as opposed to an industrial site. So, highest and best use can usually become self-evident in that, particularly when it comes to land, based on what others are doing around that land. And it establishes a valuation premise. So if the highest and best use in combination with other assets or assets and liabilities, if that's its highest and best use, then you assume that that's going to be what the market participant's going to be buying it for. Fair value of the liability or equity instrument, sometimes it's hard to fair value the actual instrument, but there is a scope within the standard to say, look, if we are struggling to fair value an asset or a liability or an equity instrument, but we can see that same instrument is held by the counterparty and there's a value on that, we can use that as a basis for the valuation. So we're not prescribed to actually value anything if we can find a proxy or an equivalent for it. But obviously it's really important that the corresponding asset being held is identical to the item that we're trying to fair value. Otherwise, the fair value will differ. Non-performance risk, this is something that often we don't think about, but in terms of liabilities, it's really important. When you fair value a liability, a market participant would consider whether or not you're likely to default on it. And so as a consequence, that is a part of the fair value measurement. And so it's important to actually ensure that that's actually considered. And there's a few other assumptions around it as well that I'll come back to. And demand feature. So the idea that if you've got an asset or a liability that has a demand feature, and it can be demanded at any point in time. If you're fair valuing it, then you have to take that demand feature into a case, and therefore it's measured at not less than the amount payable on demand discounted from the first date that the amount could be required to be paid. So for example, if you owe somebody some money, well, think about probably long service leave is a good example. So thinking about long service leave, when you think about measuring that, we don't normally measure it at fair value, but if you did, you would probably measure it at the full amount, because usually with long service leave, if it's vested, someone can usually walk in and take it at any time. So therefore, the carrying amount should reflect exactly what you'd have to pay within the time that they came in and asked for it. Fair value hierarchy, again, a little bit of a refresher here. Quoted prices, they could include, and as we work there through the different types of valuation techniques, quoted prices, it's what we often see. Exchange or dealer markets, we might see market multiples, present value, option pricing, excess earnings, relief from royalty, which is typical with an intangible asset, and depreciated replacement cost or costs. So there's a whole range of valuation techniques. The key part really is there in the slide to say they need to be appropriate in the circumstances. So, for example, I wouldn't necessarily expect to see the valuation of a residential property based on a discounted cash flow, because we don't normally think about it that way. And generally, housing doesn't generate a cash flow like, say, for example, a share in a company does. So the valuation technique has to be appropriate. Otherwise, the fair value is probably not particularly, well, it's not accurately calculated. There's got to be sufficient data to be available. Obviously, that will then play into whether or not where the valuation sits within the fair value hierarchy, so level 1, 2, or 3. And the expectation is you maximise the use of observable inputs and minimise the use of unobservable ones. I mentioned there before the fair value hierarchy. You've got 3 levels: level 1, 2, and 3 inputs. So valuations are basically put into a hierarchy based on the observability of the inputs to the valuation, and the significance of the unobservable inputs to the actual valuation. So as you're moving down from level 1 to level 3, the significance and number of unobservable inputs to valuation usually get greater. Again, maximising use of level 1, minimising use of level 3 if you can. I mentioned there at the bottom there, calibration of valuation models. I'll come back to that one, but that's really in relation to the idea that sometimes when you get in, and I'll go into more detail in a minute, sometimes you get in situations where the valuation, there is an expectation that an asset's going to be valued on a recurring basis. And on initial recognition, there might be a transaction price that you believe is fair value, but as the asset's not regularly traded, it might be a question then saying, well, is my valuation technique that I'm going to apply subsequently to this asset or liability, is it calibrated to market? And so a common thing that you see with valuers, well, what they'll do is they'll actually calibrate their valuation model, their intended valuation model going forward, to what the price is on the transaction date, just to ensure that the model going forward incorporates all the things a market participant would think about in relation to that particular asset. So it could be something like something as simple as, look, this asset has a specified amount of discounted cash flows, but those cash flows are much more risky because this particular asset is subject to uncertain legal or legislative arrangements, and so there's a degree of uncertainty about them. And so normally people would look at those cash flows and say they'd be discounted at 10%, but in fact, because of the legislative requirements or the uncertain legislative environment, they might say, look, most market participants would discount this at a high rate and therefore reflect a lower value. But I'll talk about that a bit more in a minute. 5 tricks of fair value measurement. So again, these tricks are really being highlighted or been sort of identified as through years of basically looking at financial statements, talking to auditors, talking to valuation experts, and sort of these are the ones that sort of regularly pop up to us about that provide challenges to accountants and auditors, but also to corporate finance teams. First one there I mentioned there, be very clear of the unit of account. I sort of mentioned that before, but we'll go back through a bit more detail in a minute. Number 2, be aware of the prospect that the transaction might not equal fair value. So going back to that idea that if you have to calibrate going forward, be aware that maybe is the number the right number in the initial case. Number 3, consider using more than one valuation technique for complex items, or calibrate the valuation technique at the initial recognition. 4, give due consideration to what the highest and best use for the financial asset might be. And number 5, one of my pet topics, document your assumptions and approach. Important because ultimately these numbers are going to be subject to audit. They might be also subject to other considerations. So they might be involved in contractual arrangements that might then be subject to scrutiny. So let's work our way through the tricks. Unit of account. So I've mentioned before the unit of account is the boundary of the thing that you're valuing, and so the boundary sets the outer limits of all of the features of the item for valuation purposes. And so when we talk about financial instruments, an individual asset's usually contractual. Maybe in the context of investment property, it's the legal plus the physical as the boundary. When we come to things like financial instruments, one of the things that IFRS 13 is very clear on is the saying block discounts, blockage factors or block discounts are not applicable. So if you think of it this way, you might hold a very large portfolio of the same company's shares, and you might say, well, it's really hard to sell that block as a whole. IFRS 13 actually has guidance and requirements that actually say you have to ignore those blockage factors. What you've got is a collection of individual investments, all at fair value. And so the prospect is you don't necessarily have to sell them as a block. You could sell them individually. Those blockages are important, but it sort of undermines the idea of the fair values, that if the market is for those things, then it needs to be recognised at that price of which they are being traded at that reporting date or whatever the measurement date is. Next sort of the unit of account to sort of think about is where you've got sort of multiple assets and liabilities. So, if you think about IFRS 3 with business combinations, or you think of IAS 36 when you're doing a CGU. So you might think about them fair value as a group, particularly if you're trying to get an enterprise value or some other valuation for, say, a business combination, or you're trying to get a recoverable amount for a CGU. In that situation, then obviously it's still the individual assets and liabilities, but there may be aspects to that group of things which change the value. So when you think about a CGU, the cash flows of a CGU may or may not meet the carrying amount of the asset, or may not reflect the carrying amount of the asset, subject to effectively how the asset's being managed and whether or not it's actually producing the cash flows you expect. There is some provision within 9, and it's unusual, it's only really in 9 where you talk about portfolio. So you can actually value a portfolio of assets as an individual unit of account. So there's scope in 9 to do it, and IFRS 13 accommodates that to say, well, in certain circumstances, you might hold a portfolio of assets and liabilities, but you manage them on a portfolio basis. So you're not necessarily looking at the individual assets, you're just looking at them as a portfolio. In that situation, you can actually fair value the unit, the portfolio. That's the unit of account, because that's what IFRS 9 allows you to do. And obviously the benefit of that is that the more you aggregate a unit of account with individual assets and liabilities, then obviously the volatility in that fair value movement through your P&L as a whole is obviously mitigated by having that offsetting features. So the unit account is really important, because when you start thinking about the unit account, if you don't get the unit of account right, the fair value is probably not going to be right. So think of it this way. If I have the wrong collection of assets in my CGU, and then I try to fair value that CGU, then I'm going to get a mismatch between what the fair value represents in terms of the underlying assets and liabilities, if there are any, and what the CGU's carrying amount is. So it's really important that unit of account is consistent across those two, because otherwise you are going to get mismatches, and therefore you're going to get potentially headroom that maybe is not there, but then maybe you're also going to get impairment losses which are not there either. A couple of examples, maybe just to sort of flesh it out. Example 1, cash generating unit. CDE Limited can't allocate goodwill to its 3 CGUs, X, Y, and Z, in a non-arbitrary way. So what it does is it actually tests that goodwill for impairment using the cash flows of all 3 CGUs. So it doesn't push the goodwill down into the CGUs, it sits above the CGUs, and it's a separate impairment test. Now, CDE Limited receives an indicative offer to sell CGU X to a competitor. Now, can CDE Limited use the indicative offer to test the CGU X for impairment? Well, the answer probably is it depends. So it's interesting to say that if someone was buying this, let's take from CDE Limited's perspective first. If they can't push the goodwill further down, probably what that indicates is that the independent cash flows from the individual CGUs all contribute to the synergies that are benefiting the entity from having those 3 CGUs together. So if someone came along and said, I'll buy that CGU, unless they had similar assets to insert with that or to use in combination with that CGU, they might not be actually going to be getting the benefits. So the fair value might not be reflective of what the CGU's actual value is, including its headroom to do with the goodwill. So it's important to understand, like for like. So thinking about that, it's not uncommon. It's not common, but I have seen it pop up from time to time where an entity might be offered, for whatever reason, might be offered a price for a particular part of their business, and the question is, well, can I use that for impairment testing? And usually the answer is yes, because IAS 36 doesn't make you actually use value in use or fair value less cost to sell. It allows you to choose between them from year to year. So it's important to understand that when you're doing that kind of comparison, if you do flip to the fair value, making sure it's all comparable. Example 2, listed equity instruments. CDE Limited again holds less than 1% of the outstanding shares in the small listed companies, public trading in which is infrequent. A large shareholder in the listed company has made an on-market offer to take over the listed company. The offer occurs after CDE Limited's reporting date. Now, can CDE Limited use the offer price to fair value its shares in the reporting date? Now, there's a couple of factors in there to think about. Firstly, the price that's been offered is not on the reporting date. So it's actually after the reporting date. So it's actually after the measurement date for CDE Limited's purposes. So if they were going to be able to use it, they'd have to think about whether or not it needed to be calibrated to that date. The second thing to sort of think about too is whether or not this is actually genuinely, are we talking about the same market here? So someone's offering for a controlling interest in the company, and as a consequence, whether or not that there's some blockage factors that maybe need to be excluded from that feature. Another thing you might need to consider too is why the investor is trying to buy out the company. Now, if the company, if I told you the situation was, well, in fact, the large shareholder is actually concerned about the financial status of the company. They might feel like it's actually financially uncertain. So as a consequence, what they want to do is take it back to being private. And this is why they're doing it. Then is the price being reflected, is the price reflective of maybe a duress sale or duress purchase? So a couple of things in there to think about. It's possible, but again, need to think about the details. And again, without preempting my, number 5, documentation is really important in this situation, and explaining your thinking and also explaining the evidence that you have. Now, loan number 3, loan attaching. Company A holds an investment property that's mortgaged and the mortgage is not transferable. Should Company A measure the fair value of the investment property, including or excluding the related mortgage? And what if the investment property and the mortgage were held in a trust and the company was an investment entity? So the first dot point, or the first question, should Company A measure the fair value of the investment property, including or excluding the related mortgage? Well, it's excluding, because the fair value of an asset is not linked to the liability. The liability is a separate arrangement. Now, the liability might be attaching to the asset, but the fair value of the asset is separate from the liability. It's not a part of the unit of account of the asset. Second dot point, what if the investment property and mortgage were held in a trust and Company A was an investment entity? Then potentially yes, the unit of account in that situation, if you're an investment entity, is your investment in the subsidiary. Now, if the loan is sitting within the trust, if the loan is actually sitting within the trust, not above the trust, sitting within the trust, then fair valuing the actual trust would mean that you'd expect that would be included. And so again, the unit of account is really important because it actually changes what you're including and excluding from the fair value measurement. Now, I mentioned before sometimes that there might be differences between the transaction price and fair value. And I've listed there on the left-hand side of the slide some of the scenarios that you might come across that might indicate that maybe the price paid is not the fair value. And so it could include things like the transaction has occurred in a market other than the entity's principal market. The transaction price might not be the price within the bid-ask spread, most representative of the fair value. There might be some restrictions that for some reason it had to be transacted at that price. Transactions between related parties, if it is, then the prospect is maybe that the price is not actually at market. Transaction takes place under duress, or the seller's forced to accept the price in these transactions, like the example I used before. And the unit account represented by the transaction is different from the unit account of the asset or liability measured at fair value. So the idea that maybe the things that your valuation model going forward might not necessarily be representative of what the unit of account is at the point in time it's acquired. Now, to give an example, and this is a real example. This was an example I came across when I first started doing technical accounting. Fair value of an asset subject to distressed sale. So ABC Limited holds an investment property and accounts for it under IAS 40 at fair value. And during the reporting period, ABC Limited's financial position deteriorates to the point where it's required to sell the property. So there's nothing wrong with the property. It's just a case that it has to basically liquidate the property because it has a liability to extinguish, and it's unrelated to the value of the property. At the end of the reporting period, ABC Limited receives an indicative offer of the property that's significantly less than the likely value of the property if ABC Limited had time to properly market the property. IAS 40, paragraph 33, requires that entities that choose the fair value model are required to measure all of their investment property at fair value at the reporting date. So the question is, which value does ABC Limited recognise the investment property at on balance date? And should ABC Limited provide additional disclosures in respect to the likely proceeds receivable after year end? The answer to the first dot point question there is obviously it has to be at the fair value. So if there's any indication that the price being offered is a duress or stressed value sale, then in that situation, that can't be used as it's not indicative of the fair value. With regards to the second dot point, the question, should they disclose it? And the situation we dealt with is yes, they should, because certainly users would be surprised if that transaction hadn't otherwise been disclosed. When the property was actually sold, I'm sure the users would be surprised that it's actually been sold for less than its fair value. So it's important in that kind of context to think about what the implications are going forward. So from the investor's point of view, what's their understanding of the transaction? If you're valuing it at fair value, but you know you're going to sell it, but it hadn't necessarily been agreed to at the reporting date, as a consequence of that, then the expectation would be that you'd provide that information because it is relevant to their decision making going forward. When it comes to valuation techniques, more is better. Obviously, not all valuation techniques are appropriate for every situation, but certainly more are better because they come at the valuation or the fair valuation from different perspectives. Discounted cash flows can be useful, but obviously sometimes there is some questions about future, there's always an element of estimation about discounted future cash flows. And having market prices also helps to give some perspective to what market participants might think that something's worth. If there's been a significant decrease in the volume or level of activity of the asset or the liability, that would be a good indication that maybe there's an alternative measurement models required. So market prices might not be as helpful because the market's no longer as active. If more than one measurement technique's used, determine the point within the range that's most representative of the fair value under the current market conditions. So you would expect that if you apply different measurement models, you might get slightly different numbers. If you've got exactly the same numbers, you'd probably be suspicious as well. But if you've got different numbers, then you need to also consider where does my fair value sit between them. So it might be a case that it's an average between them, but it might not be. So it might be a case that you take the view one is more likely to be the fair value than other measurement models, perhaps because of the inputs used or perhaps because of the assumptions made. That as a consequence of those, you might say, well, this is probably the most representative because it's the one's closest to maybe some level 2 or it has the most level 2 inputs or, some level 1 inputs used as assumptions to level 2. I mentioned before about calibrating the models. I won't go into detail again. I think as I've probably explained it pretty sufficiently before, but the key part is to understand that if going forward you're using a valuation methodology that's highly reliant on unobservable inputs, it's useful to actually calibrate the model at the outset to make sure that those assumptions going forward are calibrated. And it doesn't mean that going forward you might find that you have to change your assumptions, but it just might mean that at least there's no unexpected changes in respect to those assumptions. So the idea is that if you can bring them closer to reality at the date of the transaction, then the model going forward will be much more robust and much more stable. Highest and best use. Really important part of that one is to understand that it can be, non-financial assets can have different uses, and sometimes those different uses are feasible and therefore the value should be reflected. And if you think about it, it's like an opportunity cost. You don't want an entity sitting on an asset and necessarily saying it's worth nothing when you know it's actually worth something, and them not then being able to justify the use of that capital in an appropriate way. Physically possible, legally permissible, financially feasible, I sort of mentioned those before. Maximum fair value yielded by use on standalone basis or in a combination with other assets. So you have to sort of think about how's it best used, and if it's best used in a group of assets, then hypothetically, the market participant would probably have those assets. Therefore, what would they pay in that context? Other factors relevant to the highest and best use assessment. What if the entity's acquired an asset for defensive purposes? So they're actually just taking it off the market, so to avoid impacting. Now, in terms of the fair value, then you have to give that some thought, but you'd also have to think about what the implications were for your other assets, because presumably that would assist your other assets that you hold prior to acquiring this defensive asset. That would actually assist their cash flows as well. So there's a bit of a mix and match in there that you have to think about what the implications are. What if an entity's acquired an asset and it doesn't intend or expect to use it? I have seen that in practice. There's no distinction between fair value in this situation. So again, management's intended uses are not important here. The fact that they've acquired it, it should be fair valued and therefore should be recognised at that amount. I can think of a good example where an entity that bought a group of brands, one brand they decided that they weren't going to put the energy into because they didn't have the time at the time to actually exploit it. They subsequently found, and I won't say who it was because the brand turned out to be incredibly valuable, especially on a net margin basis, because it had very, very low cost of production and it just produced stuff that for whatever reason the market just loved at that point in time. They had originally thought about valuing it not at zero, and they were prevented from doing so because of the standard saying, well, no, it has to be fair value. And the interesting thing was that its value actually exceeded its fair value. But the important part was that the users understood that they had that brand and that they could do something with it. Last but not least, can I apply the highest and best use by analogy to financial assets? And the quick answer to that is no. It really has to do with that idea that highest and best use, there is really, when you're dealing with a financial asset that contractually prescribed cash flows, then highest and best use will be always its contractual terms. There isn't an alternative way you can use necessarily a financial asset to get a better number or to get more value out of it. Property, yes, there is ways you can use it to get more value out of it. I've got an example there, the land acquired in a business combination. It's sort of self-explanatory. I'm not sure if I think it's probably worthwhile just moving through that one. But at a very, very high level, the idea is that if you are dealing with a piece of land and it looks as though it could be rezoned in a way that could be sold for a higher value, then or utilised at a higher value, then you have to actually consider that whether or not that's actually physically feasible, financially feasible, legally feasible. Typically, rezoning can be challenging. But obviously, if you're in a situation where the land is surrounded by other rezoned, then the chances of being able to be rezoned is probably higher than what otherwise would be the case. My pet love, documenting accounting policy papers, documenting your assumption, documenting your assumptions, documenting the fact pattern, making sure that you've explained the accounting treatment. I've mentioned this, I've used this slide before. ASIC talks about it, we talk about it. It's really important to do it because the little bit of effort that you can put in or actually engaging someone to help you put that into place, the little bit of effort that it does take, and it feels like at the time maybe there's a bit more effort than it is, can save you an awful lot of effort going forward. And not to say that when you document everything it's going to be absolutely perfectly right, but I always find when you document stuff, because you're actually physically documenting it, it slows your thinking down to ensure that you've actually got the right logic. It's that sort of slow thinking mindset that you need to have, I think, with accounting policy papers, is that you slow down, you think about the logic to your answer, and particularly when you actually have to put it on paper, or as in on computer file now. But when you actually have to slow down to type it in, that's when the logic of something usually becomes obvious to you. So the logic will become obvious, or the illogical aspect to it will become obvious to you. Maybe there's something you missed, or also the evidence, making sure that you've got all the evidence. So when you document it that way. So I like policy papers, not because they're evidence and they're required. I think that they're an incredibly useful way of structuring your thinking and ensuring that you're getting to, if not quite the right position, at least you're not going to go completely off the range and find yourself in a scenario where you just can't justify what you've done. So important to remember that. That's my pet love. I've probably hit upon all those things, but the key part certainly with, and I mentioned there the market participants, you don't have to identify any particular person or any particular company as a market participant, but you have to think about what they would what would be their main features? What would they be thinking about when they're thinking about valuing this item? And that's really, essential to ensuring that you are picking the right people, you're picking the right market, that everything's documented in a way that ensures that it's consistent with the standard. So again, I can't push policy papers more hard because I just think that they're really important. 5 traps to fair value measurement. For those of you who've done fair value measurement and done the disclosures, none of these are probably going to be a big surprise for you. So misclassification in the fair value hierarchy, typically between levels 2 and 3, is a key mistake. Incorporating entity-specific features and/or intentions, often that's sometimes that can be just by accident, but sometimes it's because we don't have the assumptions, or we don't try to get the assumptions to actually fill the gaps. Boilerplate fair value disclosures, that's a really common one, and I'll go through that. Not updating assumptions, again, critical. You expect if you don't update assumptions in the fair value, the numbers are not going to be correct. And failing to adjust your own credit risk. And that's in very specific circumstances, but I'll touch on those as well. So just as a quick background to levels, level 1, is there a quoted price for an identical asset or liability in active market? So critical part is quoted, active market. If yes, always use level 1. So usually, typically, ASX top 100 shares. When you start moving out of the ASX 100, I know there's some views that maybe it's not as active. Again, you need to actually look at the individual company to make sure that there is some sort of evidence to suggest that the price moves with trades. If you get down to level 2, it's still an observable input, but it's not necessarily related to that asset or liability. So it's not directly the quoted price. So it could be things like an interest rate curve or something like that that's indicative of interest rates, but not necessarily the actual asset or liability you're dealing with. And then when you get down to level 3, you're probably talking about estimated discount cash flows in the future, discount rates that are estimated based off maybe using a market rate of interest that may or may not be relevant, or entirely relevant to the particular asset or liability. As I mentioned before, misclassification is usually between level 2 and level 3, and it's really significant because I've just listed on the slide there is that at level 2 and level 3, both levels of fair value measurement are subject to the same types of disclosures around valuation techniques and inputs. However, when you get down to level 3, it's really quite detailed, and it's not unsurprising because level 3 is unobservable. So it's not surprising that the accounting standard setter said, look, if you're going to do a level 3 fair value measurement, we want you to not only disclose all of your assumptions and valuation techniques around it, but also tell us where it fits in. So what's the magnitude of it? How much of it's unrealized, how much of it's realized? And so it's really significant in that context is that it can actually change the face of your financials quite significantly. Typically, we see entities at the margin, and that's across the board at the margin, sort of making it, and there is some judgment involved. It's not an easy assessment because we're talking about significance. So it's not a quantitative judgment; it's a qualitative judgment about whether this whole valuation fits in level 2 or 3. But certainly, if you found that you've got 1 or 2 unobservable inputs in the valuation, and they could change quite easily and they could have a material impact on the value, then you'd expect that the level 3 is probably the appropriate place to be. I've listed those there, but obviously I think it's self-evident that if you make that misclassification, then your financial statements, the disclosures certainly look much, much different. I'll provide an example there. I suppose the key one with this is, I'll go it quickly. So Company Z holds units in the unlisted managed investment scheme, product disclosure statement which states that the trusts hold only assets and shares of listed equity instruments. Can Company Z classify the units in the unlisted MIS at level 1? So the question is that just because the underlying assets are listed, does that mean that the units can therefore be, by analogy, treated as a level 1 investment? And the answer is generally no, because you can do this evidence yourself. Like if you looked up any of the listed investment companies, if you look at the share price and you worked out their market cap, and then you worked out what their net assets were, there'll be a difference between the two things. And what the market is doing there is actually saying, I know that you've got listed shares, but I know that as a company, you're going to take a certain amount of the profits from those shares to run the company. So the value to me of the unit or the share in the listed investment company is different from the value of the underlying shares. Now, in this situation, it's critical, again, the unit account being driven here is the actual unit in the unit trust. And so when we're valuing the unit trust itself is not listed, so it doesn't have a quoted price. We're using effectively level 2 or possibly level 3, subject to significance of things like the difference between the values. We're using those as evidence of the valuation of the units, and so consequently you can't typically use level 1 for that kind of valuation. Incorporation of any of the following into fair value measurement is generally inconsistent with IFRS 13, and that's not unsurprising because we talked about it being about hypothetical market participant, not about the entity's specific information. So assumptions about the acquirer's own future plans of the asset, how the assets, maybe how a transferred liability might be settled, so if it's settled by shares or by cash, or when it's settled. Entity specific as opposed to instrument specific restrictions over sale. So I mentioned those before, that if there is a restriction over the sale of a particular asset and it's being determined because of the entity that's holding the asset, if that restriction doesn't apply to all assets of the same class across the board, then it's probably entity specific and therefore to be not included as a part of the fair value measurement. The entity's unwillingness to sell the asset or transfer a liability at a particular price, I mean, again, it's entity specific, so it's not relevant to the fair value. And entity specific assumptions regarding cash flows, discount rates, impacts, risks on cash flows and discount rates, dividend payment ratios. So it's not to say that an entity can't use its own cash flows as a starting point, but they do have to start to think about if what the reliability of those estimates are, and also the implications of risk. So for example, just because an entity understands its business doesn't necessarily a market participant would see it in the same way, or would see the cash flows in the same way. And so as a consequence, you need to think more about when looking at those numbers. You can use them as a base, possibly, but it's important to understand they have to be adjusted to reflect what a market participant might do to those inputs if they're thinking about that entity or that particular asset or liability. Here's another one of my pet hates, boilerplate disclosures. I've picked just a couple here just to demonstrate, but the first one, I'll leave it to you to read it, but I mean, it tells me nothing. I often read these in financials and I know why entities do it because everyone does it, and you've got to sort of explain this. But I think we're at a stage where I think everyone, if you're a user of financial statements and you don't know what fair value is or how it's being used, then really, you're not. I don't think the financials are helping you in any way. It's important to disclose if you're taking an option. If you, for example, used an option to say, for example, property, plant, equipment, is to say, well, I've chosen the option, I'm going to maybe classify this particular class of property, plant, equipment at fair value, and value it at that on a recurring basis. I think it's important to disclose that because obviously it's an accounting policy option you need to understand. Usually self-evident from the accounting numbers, but again, I think it's still important to actually explain it and then to be able to explain how that fair value is calculated. But these kinds of disclosures often are too generic for users to be of any benefit to users. The second one there I put there, the carrying amount of the trade receivables, trade payables and variable rate borrowings approximate their fair values due to their short-term nature and variable interest rates. Now that's as a consequence of a requirement in IFRS 7, which sort of says to you if there's a difference between the fair value of your financial assets and liabilities and their carrying amounts, you should tell us about it. Now, typically that's not an unreasonable statement to make, but what I've found is that often entities will have other disclosures in their financials which would undermine that statement. So for example, it's not uncommon to find in a related party disclosures note also saying that these particular debts are not at market. Now, if they're not at market, then the question would be okay, are the carrying amounts actually the fair values, or are they another number? So for example, and it might not necessarily be related to cash flows, it might be about guarantees, it might be about other aspects, so other contractual features that have been not enforced in that particular circumstance because of the related party transaction relationship. And so then the question would be, are these actually impacting the fair value, or should they have actually impacted the carrying amount? So it's really important to sort of think when you make that statement, just make sure that it actually is not undermined by something else within your financial statements that suggests otherwise. Last one there, fair value reflects management's intention to hold the asset and expected future plans. Well, that's not a fair value disclosure. That's just incorrect. I've listed there a whole lot of other disclosure mistakes that we often see. I mentioned misclassification between the levels, and particularly level 2 and 3, not disclosing adequately or at all valuation techniques, and sometimes you often see a valuation technique described as an internal valuation method. It doesn't it doesn't help. It doesn't tell anyone what you've actually done. It could be anything. It could be discounted cash flows. It could be an option pricing model. It could be anything. Not disclosing key unobservable inputs such as discount rate, growth rate, terminal value, credit spread, and so on. No sensitivity analysis. So when it comes to level 3 disclosures, there has to be a sensitivity analysis for those significant level 3 inputs. Incomplete reconciliations, and then no disclosures between transfers, particularly between level 2 and 3. So they're the kind of areas we often see, and they're very common areas that are challenged in reporting. I don't think I have to sort of go into detail too much to the idea. If you don't update your assumptions within your fair value model, then the number's not going to be right. And it cascades, so you're starting out with saying, well, okay, my fair value number's not right, therefore maybe fair value gains and losses are not correct, therefore my income's not perhaps correct. I've probably got disclosure deficiencies then. I've got possibly impairment implications if the numbers haven't been correctly calculated. I've got the prospect of material misstatements, and then I've got a question about my auditor and regulatory queries. So as a consequence, I think the consequences of not updating your fair value models are usually self-evident. The last one I just wanted to highlight was this one to do with fair value and own credit risk. So we don't see it too often. It's not a common sort of treatment, but there is prospecting in accounting standards in IFRS 9 to look through a financial liability instrument with a conversion feature, to actually look through it and say, rather than separating them, separating the conversion feature, what I can do is treat the whole instrument at fair value. And to me, that's the standard set of saying, look, fair value is okay. Like in certain circumstances, we can just accept fair value for lots of things, and this is another situation. So, provided the embedded derivative it doesn't have particular characteristics, and I won't go through those, but it's provided it meets certain criteria, what you can do is you can value the instrument as a whole at fair value. And sometimes we see entities taking that approach because they might say, look, if I separate out the host debt, which would normally be measured at amortized cost, and I separate that out from the conversion feature, which might be a derivative liability, and I have to get that derivative liability valued every year anyway, why not just get the whole instrument valued? And so that's a pretty common one, and often that's helpful too in situations where there's a lot of uncertainty around the timing of the host debt. So there might be a case where it's not quite sure when the host debt might be terminated or settled or cancelled, and therefore the derivatives settled or cancelled. So it's not uncommon to see entities then going for the fair value option. Now, when you do that, if you're doing it to a liability, you've got to realise is that there's an own credit risk involved in there. So the idea is that if you're fair valuing it, you're saying, what would the market participant take? What would I have to pay the market participant to take this off my hands? Now, an underlying assumption of the fair value measurement model is that it's the same default risk before and after. And so it's not, you can't just assume that if you pass the liability off to a third party that somehow your risk associated with default disappears, because you've still got it on your balance sheet. And so as a consequence, when you're fair valuing a liability, you have to think about own credit risk. Now, when you actually have to do the own credit risk, then there is the prospect that maybe that own credit risk is recognised in P&L or OCI, so changes in own credit risk. Now, it seems an odd thing to do, but when you think about the reasoning behind it, it leads to some very odd accounting. So if your prospect of default increases, the value of the loan will go down. What that means is you can have a gain in your P&L. And so you can see what the standard setter's thinking was to say, well, don't like the idea of necessarily you fair valuing your liability downwards and taking a gain, when in fact what's happening is your credit risk is going up. And so what the standard setters require in this situation is if you do capture that own credit risk in the valuation, and you're expected to do so if it's material, you capturing that own credit risk, then it needs to be recognised somewhere. So ensuring that users understand that there's some portion of it that's related to default. And if your default risk is going up and therefore you're recognising a gain, you're putting the users on notice to say that's not a real gain. What that actually is you saying that you're becoming more likely that you're unable to actually meet that liability. And so as a consequence of that, often when we see entities for practical reasons might adopt the fair value option in 9 for things like financial instruments, with conversion features, they have to also actually do the disclosures around the impact of the own credit risk on the valuation. And that sort of brings us to the end of the presentation. I'll just quickly go through as we always do, our IFRS and Corporate Reporting offering. And I mentioned before my talk about policy papers. Yeah, it is my pet love, and I happily admit that, because I think it's really important. You know, often we have to help clients who have got themselves into a situation where maybe some expectations or some assumptions were made previously that weren't correct, and as a consequence, things were revealed to be no longer actually consistent with their reporting. And it's a really common thing that happens. And all I say is that sometimes a little bit of preventative action can avoid a whole lot of pain going forward. And that's what I see accounting policy papers doing. Is I know that they take time, and I know sometimes they're costly, but I think on the whole, my experience has always been the time you invest is going to be well and truly paid back to you over time, as is whatever money you pay to actually have them sometimes. Because often those transactions or events that you haven't maybe fully documented your accounting around, they can become quite significant going forward. And the accounting, therefore, can be very difficult to unwind if you've discovered that they're no longer appropriately accounted for. I just see it as an form of insurance, and it's a great form of insurance. In any circumstances where you have that situation, very happy to for people to reach out and have a discussion with any of us around the BDO network. Clark in Queensland, we've got Kevin in Sydney, myself in a letter in Melbourne, Lynn in Adelaide, and Ashley in Perth. Mentioned before our reporting insights, in terms of webinars, we've also got the reporting insights, the Corporate Reporting Insights, which is a monthly e-magazine that we actually issue to clients and to audit clients as well, that give updates on financial reporting matters that have occurred in the past month. Educating and learning, our learning hub is still available for those who are interested. Certainly is a good time to be thinking, if you've got a little bit of spare time, actually start to prepare yourself for next year, particularly around IFRS 18, if those are important. I'll mention also sustainability reporting. Obviously, this is the first year of mandatory sustainability reporting. We're coming right up to it, 31st of December 2025. The BDO offers a range of services in the context of sustainability. So we have carbon accounting, sustainability reporting, sustainability and decarbonisation strategy, as well as sustainability assurance. And a list of the BDO staff who are involved in the sustainability offering at BDO. That sort of brings us to the end of the presentation. I'm a little bit over time, but I think I've just about hit it. Thanks very much for joining us this year. Thanks very much to everybody who's attended webinars and reached out with questions. Apologies to those who've sent questions in and we haven't had a chance to respond to them. We do try. And certainly they do inform our presentations going forward. So please do keep those questions fine, because they're really interesting and they really help us. Otherwise, I'd like to say Merry Christmas or Happy Holidays to everybody on the call, and hope you have an enjoyable Christmas holiday break and successful 2026. We'll hopefully see you back here in a couple of months' time. I'll speak to you soon. Okay, goodbye everybody.